The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon, everyone. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss an episode, you can catch me out on YouTube, or Apple, Spotify, the Main Street Code for Financial Success. You can always go to my website, themainstreetcode.com, and find my past episodes there. And when we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors and people across the United States with complex insurance issues, life insurance, long-term care, disability, planning, charitable planning, life settlements, all kinds of issues around insurance. But sometimes we have other issues regarding taxes and retirement that really you need to discuss, and you need to have a group of financial professionals to help you. Today, I want to bring, as I always do, try to do, bring Wall Street down to Main Street. And one of the areas that I want to cover today is a very complex strategy called Charitable Remainder Trust. And you'll hear people on Wall Street talk about this, but for us every day, very rarely do we hear about things like this. And the regular insurance salesman may not understand it or know it, because their goal is to understand insurance. 90% of attorneys really have never put one together or really understand that you can do this and why to do that, unless they're in the high-end estate planning market where they handle this on a regular basis. It's not something they come across every day because people don't think about it. So what is a charitable remainder trust, and why is it something that some people might want to consider? So we have a situation here on Long Island where one of my listeners came in to see me yesterday. And this is a common situation. So they live on a farm. It's a very large farm, 25, 35 acres. And they want to sell and get the heck out of town, which is okay. That's the retirement strategy. So what's the best way to sell it? Well, you can go to a commercial broker, list it, and sell it. But you do have a partner, and that's called Uncle Sam, and he takes a big tax hit for this gain that you're going to have. Now, particularly on Long Island, land used to be pretty cheap, and if you have a farm that's been in your family for many, many, many years, or you've got an investment portfolio that's grown tremendously because you've been in the tech industry and you're ready to sell or cash in, there's a big tax to pay. You got to pay Uncle Sam. So they want to maximize the sale of their property. Now, there are lots of investment people out there that'll talk to you about something called a 1031 exchange, where you can exchange a property for an investment property somewhere else, or your own investment property. So it could be done sort of in a property, sort of an investment, and you can avoid paying taxes now, and that's a cool thing. It's a nice thing to do, to be able to exchange. Eventually, you might have to pay taxes. Okay? You're pushing it down the road, and it's a good strategy to push the taxes down the road. How do I avoid paying huge capital gains taxes now? Now, if it's been in the family, the nicest thing about real estate is you get something called a stepped up in basis, which means I leave my house to my kids. They get the value of the house today, not for when I bought it. That's called a stepped up in basis. So I may have paid $100,000 for my house. Now it's worth $500,000. Well, they get a stepped up in basis. Now, one of the nice tax things that the government has allowed is if it's a house and I'm going to another house, there is a $500,000 tax exemption based upon the gain if I sell my house and move into another house. So I can mitigate or minimize my tax burden if I'm going from house to house. But in this situation, I'm going from a farm to somewhere else. Okay. And I want to cash in because this is my retirement. So in this situation, every situation is different. Everybody's situation is different on how they do things. This is why even the simplest thing to do is call a broker, sell it, pay the taxes, and move on. But is that the most cost-effective or beneficial to you? So what a charitable remainder trust does, if I have a very highly appreciated asset, a house, a stock portfolio, a business, and I go to sell it, the IRS says, I'm going to go back to what they call the cost basis. What did it cost? And what's the difference? And I've had it for a long time. And there could be, let's say, a 20% federal tax. It could be a New York state tax also. But let's just use that 20% for an example. So here we have a situation where it's a farm. And let's say the farm sold for $5 million. Okay. And let's say because it's been in the family for decades and decades and decades, they only paid $100,000 for it. So the difference between $100,000 and $5 million, you're close to paying 20% of, let's say, $5 million, okay, is how much? $1 million. That's a lot to just give away. So what am I going to walk away with? $4 million. Well, I just sold something for $5 million, but I'm walking away with $4 million because I had to pay the government off. That's one way of doing it. Another way of doing it is doing what we call a charitable remainder trust. We take the appreciated asset, okay? And if you ever listen to Jim Cramer and the investment guy, he's always making investments in his charitable trust. Why? He's not paying tax on it. The charity itself will actually sell the asset. You're going to gift it to the charity with the promise of leaving a remainder asset of 10%. When you die, that charity will get whatever that remaining asset is. The charity basically will sell that farm for you in a 0% tax bracket because charities don't pay taxes. So you're gifting it to them. They sell it. With that lump sum of money, you're allowed to take first off, you're going to get a tax deduction for doing this. And on that remainder balance, you're going to portray. So if that remainder balance is 10% of $5 million, you're going to get a deduction, a tax deduction of $500,000. It's pretty big. This is how the wealthy do it, folks. We're talking about what Wall Street does, but I want to bring it back down to Main Street. It's that important. So from, let's say, that $5 million that the charity just sold it for, I can take out, let's say, a 5% income for the rest of my life. 5%. So it's $250,000 forever. Now, I don't have control of the asset. I do have control of the investments to some extent on how that money's invested, but I can continually take that income on a steady basis up to 50% income, but you don't want to drain that asset completely. You want that income to last. So again, according to your age and how we want to structure it, we're going to take out an income, a tax-favored income for the rest of your life. Now you say, but that's my only asset. Well, in advanced planning, where do I come in? not only help design this with the proper attorney and the commercial real estate broker and everything else and putting this all together for you, is we do something called a wealth replacement trust. It doesn't have to be in a trust, but it could be. And we fund that income and we purchase life insurance to give you tax-free death benefit to replace that asset, and long-term care if you need it, to protect that asset if you need long-term care. And we use that income and we protect it on the other side, so you have a really tax-efficient environment. And that's how a charitable remainder trust works. And after the break, we'll go into a little more detail. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to reach me is 631-647-4694. Thank you. All right. Welcome back to the Main Street Code for Financial Success. If you were listening prior to the break, we talked about a very advanced concept called a charitable remainder trust. Listen, the average insurance guy is not going to understand this concept or even discuss it with you. But it is a very tax-efficient way. Again, we're bringing Wall Street down to Main Street just because you're not heavily involved in the market and everything else doesn't mean that some of these tools can't apply to you. All these are tools to help you advance your retirement and increase it. Now, I discussed this situation with my attorney, my estate planning attorney, who puts together charitable trusts for high net worth people all the time. And he asked me a question. Are these folks charitably inclined? Well, let's think about that. Aren't we all charitably inclined? Well, here's our options when we pass. Here's our options. We can leave all our assets to the government, the federal government, the state government, for them to decide what to do with them. That's a choice. We do nothing, that's what happens. Okay? Leave it to them. They'll do, you know what? They'll spend that money going to a war in Iran or Israel or wherever they want to do, or they'll do something else. Maybe they'll do something we want them to do. Maybe they'll do something they don't want them to do. But that's an option. Option B, leave it to my family, my children. If I don't have children, my cousins, my brother, my sister, whatever. I can leave my money to my family. Option C, you can leave it to a charity. Maybe I don't have children. Maybe this is, am I charitably inclined? Well, I'd rather leave it to something that's going to do good that I know I've had a stake in my personal reality than leave it to some government who's going to spend it any way they want. So it's still a choice. But we have these choices. After we're gone, we don't have that choice. That's why planning is so important. Prior to going, we have the choice. Where are we going to leave? So I asked the attorney, are they charitably inclined? Yes and no. We're all charitably inclined, I would think. We all care about something. It doesn't have to be a religion. It doesn't have to be we're all, it can be, but it doesn't have to be. Charity means in helping other people and improving their life. And, some people own farms, want to make sure that farm remains a farm. That's their legacy. Or if you own a business and you want to sell it, you want to make sure that business still thrives. It's still part of what you built. And you may not want to see that just disappear and go to the government. You may want your family to run that business. You may want somebody else, but you want that business to live. It becomes part of you. So when you're doing charitable planning, it's not always, we're charitably inclined. Let's think of ways we can help one another and save us taxes today, because our partner today, whether we like it or not, is the government, is state and federal taxes. State and federal taxes are necessary for us to live. Let's call it what it is. Somehow, it's disproportionate that the people on Wall Street and the billionaires pay less taxes than we pay. It's very disproportionate because they utilize whatever tool they can to minimize their taxes. That doesn't mean that you can't as well. So I want you to get your head wrapped around the fact that, okay, I'm not making billions of dollars on Wall Street. If I am, thank goodness. I'm sure you're not listening to my show. Maybe you are. But let's bring it down. There are things we can do at our level to protect our income, for legacy purposes, for our own protection purposes, to live a better life so that we have income we can't outlive and protect that income in case emergencies happen, which they do in every life they happen. So that's what I want to do is bring some of these high net worth strategies down to you, because guess what? You not being told on a daily basis how to protect your assets and how to maximize your retirement by the average people out there working with you. Your investment people are concerned about your investments. That's where they make their money. Your insurance people are concerned about selling you an insurance policy because they're commission based and they get money when they sell you a policy. But how does it fit into the overall scheme of things that are going to make you very, very tax efficient? Now, at the beginning of the show, and for the bulk of the show, I talked about a charitable remainder trust. Now, let's say you have a lot of assets in IRA money. So this is part of a strategy with IRA money because, as we talked about on many shows, we talked about the Secure Act 2.0. Where if we leave our IRAs to our children, we are hurting them financially because they're going to have to take that money out over 10 years. And that could put them in a horrible tax bracket, or it could jeopardize them from getting government services. You're forcing money into people that's 100% tax and throwing them into a different tax bracket, and or if they're older, making their Social Security taxable where it was untaxable. And combined with their income could really deteriorate that asset because it wasn't spent during your lifetime. So a charitable remainder trust is an interesting tool, income tool, which is very tax favored, that can be used also in combination with your IRA distribution strategies. Listen, all these investment guys can tell you how to invest your money and how to grow it. But I'd like to talk about different tax classes on, okay, now we're there at retirement. What's efficient for me to take and use? What money can I use that's tax-free? What money is taxable? This creates a whole new set of circumstances. And if I pass, what money is taxable to my heirs? What money is tax-free? Is my property taxable? These are complex things. Listen, you could do nothing and just pay a ton of taxes, which is your partner, and you're welcome to do that. The wealthy are not doing that. They're finding strategies every day on how to minimize taxes and maximize return to themselves and to their families and their legacy. That's what the wealthy, ultra wealthy do. That's what some of the wealthy does. And I'd love everybody to be as tax efficient and income efficient as possible. Taxes are a thing, yes, very important in our social well-being. But the burden shouldn't be entirely on us to pay all the taxes. And we need to find efficient ways to be tax efficient. One of the most efficient tax tools out there, besides the charitable remainder trusts and wealth repayment, is life insurance. Very tax efficient. Roth IRAs, very tax efficient. Roth 401ks, very tax efficient. Most tax efficient life insurance. Why? I can put unlimited contributions into a life insurance policy and it'll grow and never be taxed afterwards. I'm using after-tax money, but that money grows tax-deferred, just like your IRAs and 401ks and your Roth. And I could take it out tax-free, and I don't have all the rules and regulations. I could take it out when I'm 50. I can take it out when I'm 55. I could keep paying. I could stop paying. I could borrow money. I could buy real estate. I could sell real estate. Never pay taxes, never have Social Security. And if I pass away, I get a tax-free death benefit. There's nothing better in the world than a good, well-structured life insurance policy that can do multiple things for you from a standpoint of living and passing on a protected tax-free legacy. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3. I welcome your questions, your comments. Come in, make an appointment. Let's sit down and figure out your financial situation. Give me a call, 631-647-4694. Thank you. Have a wonderful afternoon.